Welcome to Foundations of Real Estate Financial Modeling. Today we're going to go over the definitions of what a modified internal rate of return, how it's different from a regular internal rate of return, and we're going to close the loop with some sample problems. So a modified internal rate of return is basically, as it sounds, it's an internal rate of return that's slightly modified. So one of the main differences here is that a regular internal rate of return assumes that the project's positive cash flows can get invested into the project at the same IRR. So what that basically means is that if you have a project that has an internal rate of return of 15%, then you can reinvest the cash flows generated by that project into that project at 15%. Now, that is not a sound assumption, because if you, let's say, have a project in downtown Austin, you have like a 10-story apartment complex, and you're getting an internal rate of return of like 20%, other developers in the area are going to see that as an opportunity to invest in the downtown area, and they're going to start building around your building, and your internal rate of return is going to start to go down due to saturation of apartments and competition and all that good stuff. So the MIRR solves that by assuming a reinvestment rate of the firm's weighted average cost of capital. I'm going to leave a video description below to a video I have on what the weighted average cost of capital is, and I'll go into a little bit more detail how to calculate and all that stuff. So if you're interested, check it out. And another thing that the modified internal rate of return solves is that a project can have multiple internal rates of return. So remember that the IRR is the discount rate at which your NPV is equal to 0, right? So 0 would be in your x-axis. So if you have a project with irregular cash flows, say you start with a negative cash flow and you have a positive, negative, positive, then you would technically have multiple IRRs, and none of them are correct or incorrect, technically speaking. So that's when you would have to use a modified internal rate of return and employ your NPV analysis and have a decent comparison. So with that, guys, we're just going to jump into the sample problem for today. Assuming $100,000 is invested today, for the next 3 years, $12,000 is returned annually, and in the 4th year, a lump sum of $80,000 is provided. At a reinvestment rate of 15%, what is the MIRR for these series of cash flows? Okay. So we have period 0, 1, 2, 3, 4. We invested $100,000. We're getting back $12,000 for 3 years, and then we're getting $80,000 at the end, lump sum. To calculate the MIRR, we're just going to do our MIRR function. We're going to get our cash flows. Oops, sorry about that. And then we have a finance rate of 15% and a reinvestment rate of 15%. It's the same. And there you go, guys. We have a modified internal rate of return of 6.35%. And like I said, guys, I'm going to leave a couple links to a video on what the weighted average cost of capital is, if you didn't catch the video on what the internal rate of return is, and I'll leave that in the video description as well. And I'll leave the link to the video description of the NPV video that I made as well. So with that, guys, I'll leave you to it. I appreciate your time. Have a good one. And if you like the video, please like, comment, and subscribe. Have a great day. See you.